Why do some people seem to effortlessly build wealth while others struggle paycheck to paycheck? Is it luck? Connections? Inheritance? The truth might surprise you. After studying hundreds of millionaires and billionaires, researchers found that 88% of wealthy individuals share one thing in common, and it's not a trust fund. It's their daily habits. Welcome to Financial Blueprint Diaries, where we decode the wealth-building strategies the rich don't advertise. Today, we're diving into 7 habits that could transform your financial future. These aren't get-rich-quick schemes. They're proven, research-backed behaviors that compound over time to create extraordinary wealth. By the end of this video, you'll have a clear action plan. So grab a notebook and let's build your financial blueprint. Habit number 1, pay yourself first. Most people follow this pattern. Earn money, pay bills, spend on lifestyle, then save whatever's left. The problem? There's usually nothing left. Wealthy people flip this script entirely. Warren Buffett once said, "Don't save what is left after spending. Spend what is left after saving." This is the foundation of wealth building. Here's how it works. The moment your paycheck hits your account, automatically transfer 20% to savings and investments before you pay anything else. Treat it like your most important bill, because it is. Real example, Sarah, a teacher earning $50,000 annually, automated $833 monthly to her investment account. That's 20% of her income. She never saw the money, so she never missed it. After 20 years, with average market returns, she accumulated over $480,000. Same salary, different habit, life-changing result. Start with whatever percentage you can, even 10% or 5%, and increase it annually. The key is automation. Set it and forget it. Habit 2, live below your means. Habit number 2, live below your means. This sounds simple, but it's where most people sabotage their wealth. There's a phenomenon researchers call lifestyle inflation. You get a raise, so you upgrade your car. You get a bonus, so you move to a pricier apartment. Your income grows, but so do your expenses, sometimes even faster. The wealthy think differently. They maintain a gap between what they earn and what they spend, and they invest that gap. Real example, consider 2 lawyers, both earning $200,000 annually. Lawyer A drives an $80,000 Mercedes, lives in a $3,000 per month apartment, and dines out regularly. After taxes and expenses, she saves about $15,000 yearly. Lawyer B drives a $25,000 Toyota, lives in a $1,800 per month apartment, and meal preps. She saves $65,000 annually, investing the difference. After 15 years, Lawyer B has accumulated over $1.8 million in investments. Lawyer A has $340,000 and a car that's now worth $15,000. Same income, vastly different outcomes. The formula is simple. Earn more, spend the same, invest the difference. Every dollar you don't spend is a soldier in your wealth-building army. Track your spending for 1 month. You'll be shocked where your money actually goes. Then ruthlessly cut the expenses that don't bring genuine value to your life. Habit 3, continuous learning. Habit number 3, commit to continuous learning. Warren Buffett reads 500 pages every single day. Bill Gates reads 50 books per year. Oprah Winfrey credits her success to constant learning. The wealthy don't just consume information. They invest in their minds like they invest in stocks. Here's why this matters. Your income is directly tied to the value you provide. The more you know, the more valuable you become. Knowledge compounds just like money. Real example, Michael worked in IT earning $60,000. Instead of Netflix binges, he spent evenings learning cloud computing and cybersecurity. Through free online courses, YouTube, and $200 in certification exams. 2 years later, he landed a cybersecurity role at $110,000. His investment? Maybe $500 and his evenings. His return? $50,000 extra annually, compounding for the rest of his career. That's millions of dollars in lifetime earnings from a $500 education investment. Make learning systematic. Read 30 minutes daily, finance, business, psychology, skills. Listen to educational podcasts during commutes. Take one online course quarterly in your field. Attend industry conferences and workshops. The rich know that the best investment is in yourself. You can lose money in the market, but knowledge stays with you forever. Habit 4. Create multiple income streams. Habit number 4. Build multiple income streams. Here's a sobering statistic. The average millionaire has 7 income streams. The average person has 1, their job. Relying on a single income source is like building a house on one pillar. It's fragile. The wealthy build multiple pillars. Think about it. If you have one income and you lose it, you've lost 100% of your revenue. If you have 5 incomes and lose one, you've lost 20%. Real example, Jennifer started as a graphic designer earning $55,000. Over 5 years, she intentionally built additional streams. 1. Main job, $55,000. 2. Freelance design work, $12,000 annually. 3. Dividend stocks, $3,000 annually. 4. Selling design templates online, $8,000 annually. 5. Small rental property, $6,000 annually in profit. Total, $84,000 from 5 sources instead of $55,000 from one. More importantly, when her company downsized, she didn't panic. She had options. Your income streams can include 1. Earned income, your job. 2. Business income, side hustle or business. 3. Investment income, stocks, bonds, dividends. 4. Rental income, real estate. 5. Royalties, books, courses, patents. 6. Capital gains, selling appreciated assets. Start with one additional stream. Master it. Then add another. The goal isn't to work 80 hours weekly. It's to create systems that generate income with minimal ongoing effort. Habit 5. Manage debt strategically. Habit number 5. Manage debt strategically. Not all debt is bad, but how you use it determines whether you build wealth or destroy it. The wealthy understand the difference between good debt and bad debt. Bad debt finances depreciating assets and consumption, things that lose value. Credit cards for vacations, car loans for luxury vehicles, financing furniture. This debt enslaves you. Good debt finances appreciating assets or income generation, things that create value. Mortgages on rental properties, business loans with clear ROI, strategic student loans for high-income careers. Real example, 2 friends, both 25, both have $20,000. Friend A puts it toward a down payment on a rental property with a mortgage. The rental income covers the mortgage, and in 10 years, they own a $300,000 asset that appreciated from $200,000, plus they collected rent the entire time. Friend B finances a luxury car with $20,000 down. In 10 years, the car is worth maybe $8,000, and they've paid $45,000 total after interest. The wealthy person used leverage, the bank's money, to buy an appreciating asset. The broke person used their own money as a down payment on a depreciating liability. Your action plan. 1. Eliminate high-interest consumer debt aggressively, credit cards, personal loans. 2. Never finance depreciating assets. 3. Use good debt strategically for assets that generate income or appreciate. 4. Maintain an excellent credit score for when good opportunities require leverage. Debt is a tool. In skilled hands, it builds empires. In careless hands, it builds prisons. Habit 6. Practice delayed gratification. Habit number 6. Master delayed gratification. In the famous Stanford marshmallow experiment, children who could resist eating one marshmallow to get 2 later had better life outcomes decades later. Higher SAT scores, better health, more wealth. The principle? Those who could delay pleasure today for greater rewards tomorrow win. Wealth building is fundamentally about delayed gratification. Every dollar you invest instead of spend is you choosing future security over present pleasure. Real example, 2 colleagues, both 30, both earn $75,000. Person A wants the latest iPhone every year, $1,200. Premium streaming services, $600 per year. Daily coffee shop visits, $1,500 per year. Weekend getaways, $3,000 per year. Total, $6,300 annually on immediate pleasures. Person B buys a mid-range phone every 3 years, shares one streaming service, makes coffee at home, and takes one big vacation annually instead of many small ones. They invest the $5,000 difference annually. Fast forward 20 years. Person B has an additional $280,000 invested, with average returns. Person A has memories and nothing in the bank. The key isn't living miserably, it's being intentional. Ask yourself, will I remember this purchase in 5 years? Or would I rather have financial freedom? Practice the 48-hour rule for non-essential purchases over $100. Wait 2 days. If you still want it and it fits your budget, buy it. Most times, the urge passes. Rich people ask, can I afford it? Poor people ask, how can I afford it? Wealthy people ask, is this the best use of this money? That's the difference. Habit 7. Network with purpose. Habit number 7. Build your network strategically. Your network is your net worth. This isn't just a catchy phrase. It's economic reality. The wealthy don't network to collect business cards. They build genuine relationships with people who challenge them, inspire them, and open doors to opportunities. Research shows that 85% of jobs are filled through networking. Beyond jobs, your network provides mentorship, partnerships, investments, and knowledge. Real example, David attended a local real estate meetup, free event, Tuesday evening. He met Angela, an experienced investor. Over coffee, she explained her strategy for buying small multifamily properties. David applied her advice, and Angela even connected him with her lender, who offered better rates than he could find alone. His first property generated $18,000 annually in cash flow. That one relationship from one free meetup created a passive income stream. But here's what most people miss. Networking isn't about what you can get. It's about what you can give. The wealthy approach relationships asking, how can I add value? They make introductions, share knowledge, offer help, with no immediate expectation. This creates goodwill. When opportunities arise, people think of those who've helped them. Your action steps. 1. Join one professional or interest group this month. 2. Reach out to one person you admire for coffee or a call. 3. Offer help to 3 people in your network with no expectation. 4. Attend industry events, workshops, or conferences. 5. Stay in touch, send articles, congratulate achievements, check in. Remember, you're the average of the 5 people you spend the most time with. Choose wisely. Let's recap the 7 habits that build real wealth. 1. Pay yourself first. Automate your savings before you spend. 2. Live below your means. Create and invest the gap. 3. Continuous learning. Invest in your most valuable asset, yourself. 4. Multiple income streams. Build resilience and accelerate wealth. 5. Strategic debt management. Use leverage wisely. Eliminate bad debt. 6. Delayed gratification. Choose future freedom over present pleasure. 7. Purposeful networking. Build relationships that create opportunities. Here's the truth. You don't need to be born wealthy. You don't need a high IQ. You don't need luck. You need consistent habits, compounded over time. If you implement just 3 of these 7 habits starting today, you'll be ahead of 90% of people. Implement all 7, you're practically guaranteed to build significant wealth. Your assignment: choose one habit from today's video. Just one. Implement it this week. Master it for 30 days. Then add another. Small hinges swing big doors. If you found value in this video, hit that like button and subscribe to Financial Blueprint Diaries. We release wealth-building content every week that give you the blueprint the rich follow. Drop a comment below. Which habit are you implementing first? Remember, the best time to start building wealth was yesterday. The second best time is right now. This is Financial Blueprint Diaries. Now, go build your empire.